What are penny stocks and why are they so attractive to stock market newbies? Imagine that you are standing on the threshold of the fascinating world of investments, where some are hunting for quick money and others are lost in the labyrinth of risks. Today, we will figure out what penny stocks are, why they are so attractive to beginner traders, and how, in my opinion, you can approach them more wisely to make real profits. If you like this topic, don't forget to subscribe to the channel, click the bell, and like it. Well, let's go. What are penny stocks? We all know that buying stocks is an opportunity to become a part owner of a company. For example, when you buy Apple stock, you own a tiny share of a giant with a market capitalization of about $3.4 trillion. Market capitalization is the total value of all of a company's shares, and investors use it to gauge its size and strength. But penny stocks are a whole different world. These are companies with a market capitalization of less than $300 million, and sometimes less than $50 million. The SEC classifies penny stocks as stocks trading for less than $5 a share. Some of them, trading above $1, remain on major exchanges like NASDAQ and NYSE. But the real penny stocks are those that are worth less than $1. These are the pink sheet companies that Jordan Belfort, the hero of the movie The Wolf of Wall Street, used in his machinations. These stocks are traded on the OTCBB over-the-counter bulletin board. Why are penny stocks so risky? The first and biggest risk is the lack of reliable information. This is especially true for companies on the pink sheets, whose shares are worth less than $1. They are not regulated by the SEC and are not required to publish financial statements. This means that investors simply do not know what their cash flow is, operating expenses, or whether the company has any real income at all. Companies whose shares are worth more than $1 and trade on the NASDAQ or NYSE are required to file reports. They are a little less risky, but that doesn't make them completely safe. The second risk is price manipulation. Here's where the real action begins. Many of these companies artificially inflate their stock prices. How do they do it? They publish news with big headlines and hire promoters to create excitement. The headlines flash words like agreement, component placement, strategic partnership, or breakthrough. If you read the entire article rather than just the title, you'll see that much of the information is empty promises with no basis in reality. The purpose of such news is to increase the price of shares by hundreds of percent. Examples of this are shares of companies OPTT, BPTH, YRIV, and ABIO. When the price soars, insiders start selling their shares, leaving unsuspecting investors high and dry. This is a classic pump and dump scheme. The fine line between legal manipulation and outright scams. Sometimes penny stocks use their artificially inflated share prices to issue more shares and raise more money. This is a classic scheme. First pump up the price, then sell the shares at an inflated price. We have seen many examples of this with OTC stocks. These companies hire third-party promoters to send out mass emails and publish fake articles with enticing headlines. Of course, many will say, but NASDAQ stocks are regulated and less susceptible to manipulation than OTC. In theory, this is true, but in practice, some press releases are nothing more than legal pump-and-dump schemes. The SEC considers it legal to publish inspiring news about a company, but sometimes this devolves into outright misleading information. For example, the stories of LFIN and HUNT stocks. These companies released news that looked sensational, and their shares skyrocketed from under $10 to almost $100. A 1,000% increase. Both companies ended up under investigation by the SEC and were delisted from NASDAQ, moving to the OTC. But let's be honest, these are just a couple of thousands of such cases. Most of them never reach the level of investigation. Unless it's a blatant violation like insider trading, these legal price pumps happen every day. Always be on guard. Perhaps this video will serve as a cautionary tale for new investors and traders. Penny stocks are inherently high-risk assets. Never trust promoters, hot chat recommendations, or big press releases. Always do your own research. Sure, there's money to be made in short-term penny stock trading, but don't confuse that with long-term investing. Popular penny stock illusions. The first illusion is that many of today's giants, like Apple or Amazon, were once penny stocks. That's not entirely true. The second is that if you buy a stock at 40 cents and it grows to 80 cents, you can easily double your money. In theory, yes. But in practice, It's more complicated. Let's remember why companies go public in the first place. They sell stock to raise money for development and research into new products. Their goal is not to make you rich. Their goal is to move capital out of your pocket and into their bank account. If a company is truly profitable, its stock will go up in price and investors will make money too. But most penny stocks are money-losing companies with no real products. They just keep issuing new shares to pay their expenses and salaries until they go bankrupt one day. Risk of losing everything. Sure, penny stocks sometimes jump from 40 cents to 80 cents in a day, which is attractive to newbies. But they can just as easily fall to $0.05, and then you'll lose 87.5% of your investment. Often, when a stock is delisted from the NASDAQ and moved to the OTC, its price continues to fall due to additional share issues and capital dilutions. As a result, many investors lose everything. Yes, there are exceptions. For example, Aurora Cannabis, ACB, which started out on the OTC as ACBFF and moved to NASDAQ in 2018. But the odds of that kind of success are slim to none. So instead of putting your money into penny stocks, it might be smarter to invest in proven companies like Apple, Facebook, or Disney. Yes, you won't buy as many shares as you would if you were buying something at $1, but the long-term growth of these companies is clear. And it's much safer. Let's sum it up. Day trading and swing trading penny stocks are strategies that can actually make money. The key is to understand the difference between short-term trading and long-term investing. Always do your own research and assess the risks before investing your money. Don't blindly trust recommendations. This video is not financial advice, but an opinion that is close to the author. Maybe it will help you understand the risks and opportunities of working with penny stocks. If you are interested in more detailed strategies for day and short-term trading, check out the description below the video. Thanks for watching. Don't forget to like, subscribe, and leave your questions in the comments. See you in the next video.